Welcome to the Bloomberg Markets Podcast. I'm Paul Sweeney, alongside my co-host, Matt Miller.
Every business day, we bring you interviews from CEOs, market pros, and Bloomberg experts, along with essential market-moving news.
Find the Bloomberg Markets Podcast on Apple Podcasts or wherever you listen to podcasts and at Bloomberg.com/podcast.
What's the cybersecurity outlook? Let's see, Wendi Whitmore is head of Unit 42 at Palo Alto Networks, our next guest in studio with us. Thanks for stopping. Why would you leave Palo Alto to come to New York? It's like 20 below here.
It is cold here. There is no doubt about that.
Annie, tell us, what is Unit, do I have that right, Unit 42?
Yeah, Unit 42 is really Palo Alto Networks special forces on the ground, if you will. So we consult, we solve our clients' crises, so incident response and breach investigations, threat intelligence, and threat hunting throughout the world.
And tell us a little bit about your clients. Who are they? What kind of work do they do?
Our clients really do a bit of everything, right? They are Global 2000 companies, they're smaller organizations, they're governments throughout the world. We partner with a tremendous amount of intelligence organizations to share information throughout the world as well, related to cyber threats and attacks.
Okay, what's the landscape right now in terms of cybersecurity? I mean, it's just like, I also get at least once a month, it seems now, a letter from whatever organization. Last month it was from Robert Wood Johnson University Hospital System saying they had a breach of their security, their computer systems, and some data, patient data, was leaked out. And here's a consolation prize. We're going to give you a year free of cybersecurity threat detection,
credit monitoring,
or whatever it is,
yeah.
Credit monitoring. What's the landscape right now? Things seem to have gotten a lot worse.
The landscape is a bit chaotic, especially going into 2024, where we're going to have over 60 major elections throughout the world happening in this year alone, right? This will be the largest voting that's ever occurred. So I think an easy way to remember it is the 3 S's: speed, scale, and sophistication. We're seeing attacks happen faster than they have been before. So when an attacker gets in an environment, they are stealing data within a matter of hours in some cases. From a scale perspective, you mentioned, maybe on a weekly basis that you're getting a letter, right, about another breach that's occurred. This scale, attackers for the first time in history, they're no longer doing only spear phishing, which is sending an email to an employee, right, and they click on a link and they get infected that way. They're actually exploiting vulnerabilities at scale. So within hours, there could be hundreds of thousands of systems affected by a 3CX, a Microsoft Exchange, for example. And then sophistication. It's long been certainly that nation state actors are highly sophisticated, but now we're looking at cyber criminals who have a deeper understanding of business-to-business interactions and processes than we've ever seen before, and they're using that to their advantage.
Wow. So a few things.
Scary.
I'm scared. A few things you just mentioned there that definitely made me scared. You're mentioning cybersecurity, elections, and nation states. Of course, it makes me think 2016. We are heading toward another election here in the U.S. Very likely could have Trump on the ballot again. I don't know. Do we start thinking again about potential Russian interference in the U.S. election? I mean, where is your mind at right now in terms of threats with this election coming up?
I think that's a great question, but I think the reality is we have to be thinking about nation-state interference from countries throughout the world, right? We have now, with the onset and advent of generative AI, we have the ability to speed up written and verbal communications and make them sound more polished and genuine than we've ever seen before. So I would imagine from a disinformation campaign, we're going to see more of those emanating from throughout the world, and we really need to be, concerned about where our information's coming from.
From a business perspective, and particularly one of the areas I cover, the small businesses, and they are especially vulnerable because they just don't have the resources, I would imagine, to combat this on a regular basis. They're liable when a client's information is stolen, right? I mean, from a legal perspective, they have to keep that in mind.
Certainly, cybersecurity is really a team sport at this point, and you hit on a key factor of that, which is small businesses are not only responsible for their own information, but for those of their clients, and they may have a chain where they're part of a big supply chain for a large organization that does have more resources. So that is a huge challenge for executives throughout the world today, is to make sure that not only they're securing their own communications, but their clients, their consumers, and everyone they're doing business with.
Yeah, this was actually even like a really big topic heading into Davos this week, that the survey that some of these diplomats were conducted on heading into the World Economic Forum, that they ranked misinformation and disinformation as the top risk out of 10 for the short term and the long term. So thought that, the short term risk being this misinformation. So that is really interesting. I mean, how does that then affect like the work that you do? Do you feel like this is even more like under a microscope and being scrutinized right now?
Well, I think the challenge with disinformation, for example, is it's not like a traditional cyber attack where you're necessarily stealing data from an organization and there's some piece of evidence to prove, right? It really relies on the reader, the viewer, the consumer of that information to be discerning and to understand and do their fact checking to really, get to the degree of, is this information legitimate or not? To the degree that it has impact on a business and the economy, I think that's a, true factor. So 2024, we're likely to see more of that than we've seen before.
So with computing capacity, growing exponentially, et cetera, so forth, I would imagine it's not a question of when, but not a question of if, but when you're going to suffer a cyber attack, a devastating cyber attack. How do you protect yourself?
Yeah, no doubt. Organizations are aware this is happening at a faster pace, right, than we've ever seen before. So I think the keys there are really being able to understand what visibility into your environment. So understanding what are legitimate communications and interactions, what are not. And then something that everyone can do is practice in advance, right? Practice these plans. Make sure you know how to get a hold of your employees and your team members. And in the event that you don't have access to your primary email and other types of communications, that you can really respond quickly. On a personal note, I cannot stress enough, do not reuse the same passwords for every single account, for every application.
Whoops.
And for every application you can, make sure you have multi-factor authentication enabled so that you make yourself less of a target.
And don't click those emails, John. Stay alert.
Wendi, do you have just anecdotally, give us some horror stories that you've dealt with?
Well, so for example, just last week, we're working for an incident response, meaning a breach investigation for a healthcare organization. And in this case, it's a ransomware actor. Not only did they reach out to try to extort the healthcare organization, they're reaching out individually to patients. And in this case, it's cancer patients. And they're saying, hey, for $3, you can preview the information that we've stolen about you. And for $50, you can pay us to make sure that we don't expose this further on the internet. This is horrific behavior. We're likely to see more of this as these ransomware actors continue to monetize their attacks.
Are they ever caught, the ransomware actors? Or are they in Russia or some far off place where you're never going to you just can't reach them?
Well, the great news, I think, is there's a lot more information now. So multiple governments throughout the world are collaborating on these attacks. We have law enforcement actually going after disrupting these ransomware actors, their infrastructure, so the tools that they're using to host and wage these attacks. And then certainly we are moving to the point where we're now disrupting from an actual arrest standpoint too. So good news, but still slow going in that aspect.
So one more here for you, Wendi. We had some news out of JP Morgan this morning. They were saying that they've seen an increase in hackers that are trying to infiltrate their systems. And JP Morgan spends about $15 billion a year on technology as part of its attempts to bolster its cyber defenses. Obviously, we're not all JP Morgan, but this could get very expensive.
Oh, no doubt. I mean, this has a true economic impact, right? But I think the good news there and the silver lining is we're seeing so many more organizations really effectively prepare to detect these attacks. So in JP Morgan's case, they're detecting them, they're preventing them, they're gathering data that they're sharing with the community so that more others can also protect and defend themselves as well. So I think there's a good story there as well.
Okay, I'm changing my password from JBT1234.
It's not password 123?
Oh, no, that was my old one.
Oh, okay.
Wendi, thanks so much. Wendi Whitmore is Senior Vice President, Head of Unit 42 at Palo Alto Networks. In the studio, so she gets a gold star today.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app. Or listen on demand wherever you get your podcasts.
Is 2024 the year for a rebound? Our next guest has some thoughts on that. Thomas Smale is CEO of FE International. Before we get to the deals, what do you guys do? What is the company all about?
So FE International, we focus on middle market tech M&A. So we work with buyers and sellers of companies up to generally 300 million in valuation. In total, we've closed over 1,500 transactions.
So you're in an advisory capacity?
Exactly, we're an advisor, yeah.
Okay. 2023 is a year I would imagine you want to forget. What's the outlook?
Yeah, so 2023 I think finished on a reasonable high. So if we look at our deal volume, second half of 2023 versus second half of 2022, we're up 56%. So deals are still happening, particularly in the middle market, lower middle market. I think where a lot of people see deal volume has slowed down is really those much larger transactions. So there's much less of those $1 billion and above deals happening, but there's still activity lower down.
Yeah, and it sounds like this year, obviously, if interest rates are going to come down, that should probably help give a boost to the outlook this year, right?
Yeah, for sure. I think last year there was a lot of uncertainty about what was going to happen to interest rates, and they kept getting pushed upwards. So a lot of buyers were kind of sitting on the sidelines waiting to see what would happen. Now I think most analysts are predicting maybe 2 or 3 interest rate cuts this year. So buyers are definitely getting more active, particularly those who are using debt. But on the flip side, there's still $4 trillion of dry powder with private equity firms that they need to deploy, which is sitting there in cash. So there's still the ability to do deals even if they don't use debt.
How does it work? Do they come to you mostly, or you see the opportunity like, hey, this is something that might make sense in terms of M&A, and you approach those companies?
So generally they will come to us. We've been in business like 14 years now, so we get a lot of word of mouth. Founders will come directly to us wanting us to help sell their business. Maybe they're ready to move on. Maybe they've had an approach and they want someone to help advise them, and then we'll work through the process of reaching out to suitable buyers and negotiating from there.
How do they reach that decision? Give me a specific, like when they know it's time to do something.
Yeah, so for a lot of people, it's very much a personal decision. So like everyone has, I think in the entrepreneurial world, has their number. Their number might be 10 million, 50 million, 100 million, 200 million personally they want to walk away with. When they get to that level in terms of where they can sell their company, they might just decide to walk away then. Some people walk away when they have a change of personal circumstances. Maybe they've got kids going to college and they want to kind of spend more time with them, or maybe they want to spend less time with them, or they want to take time away from work. It can work in either directions. A lot of time founders just get an approach. So they get an approach from a buyer that gets them excited about the idea of selling, and they just want someone to help kind of work through the process with them. Other times, I think particularly in kind of the current world of tech, it moves so quickly. Founders will have new ideas. So they're like, well, I've got a new business idea. How about I sell my current company? I'm going to go work on this instead, and I'll get some liquidity in the meantime.
So you'd mentioned private equity. Are you working in transactions a lot, that in which case that is the buyer, or is this mostly one business acquiring another?
Yeah, so private equity probably makes up about 50% of the deals we work on. We work with a lot of public companies as well who are trying to make acquisitions at all levels. I think a lot of people think public companies only buy billion-dollar businesses, but the reality is if there's a strategic fit, they might look at a $5 million business, a $10 million business, $50 million market cap business. And then a lot of individuals and like very small funds, you might not necessarily call them private equity, but they're kind of successful individuals or partnerships who have raised a small amount of money to buy a business as well. Particularly in the US, that's a very active like demographic of buyer.
Okay, so looking forward to 2024, are there any particular sectors that you deal with that look better than others? Where is the deal activity in terms of that?
So I think that the big trend at the moment is anything related to AI. And I think the interesting thing about AI is, even if you don't necessarily understand it, every single business out there has a way they can improve with the use of AI. Lots of other like kind of sub-industries that have come up over the years have not necessarily had that kind of ability to be applied in literally every business. So lots of companies we're working with or acquirers that come to us and say, hey, we're looking to buy a business are interested in AI, either to augment what they already have. So maybe they can add some tools or even like a team to their existing kind of business or whatever they might have. So you can augment that by adding AI, or maybe if you're building a business in the AI space, it's a great time to sell because it's such a hot market. So at the moment we have a 9-figure transaction we're representing. They've built the business in 3 years to over 20 million in revenue, no outside funding, currently actively looking for a buyer. And it's so far extremely interesting with buyers just because of the amount of kind of AI focus it has.
Last one here for you, Thomas. We've been talking a bit about earlier in the show about the regulatory outlook for M&A, especially with the JetBlue and Spirit deal that didn't come through. So tell us a little bit about that from your perspective, and especially if we're heading into an election year and maybe that administration could change.
Yeah, so I think buyers are always aware of political changes, and that's not just necessarily in the US, that's geopolitically. There's things all over the world that could affect deals. So from that perspective, buyers will always be thinking about it. Regulatory risk is very much specific to the industry you might be working within. So recently we worked on a business in the CBD space, which we successfully sold, but there's constant regulatory changes with CBD. So if you're an acquirer looking to buy businesses in that space, either you're going to be extremely confident and knowledgeable of that industry, or you're going to do a lot of extra research into what might necessarily change or what could potentially change in future, or maybe you'll even risk adjust your offer and say, well, there's regulatory risk in this market, we're going to pay less for that business.
Thomas, a pleasure, and thanks for stopping by. An in-studio guest, a gold star for Thomas Smale, CEO of FE International, advising on M&A.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Joining us now, Robert Schein, Managing Director, Partner at Blanke Schein Wealth Management. How does an investor play this back and forth? Fed going to cut March, now it's later, fewer cuts maybe. How do you view all this?
Well, good morning, John and Molly. And I think if we go back a month ago when I was in the Bloomberg radio studios, I did say that, the markets were anticipating and asking for, in 2024, a rate cut. In fact, obviously you saw equity markets, risk assets price that in super aggressively. We were in the camp of, as I said then, and I still believe that it's going to be higher for longer, and the Fed Reserve is going to have to walk that tightrope, simply because if you look at the sort of trajectory of inflation through history, you get two humps of inflation, and the Fed can't pull down sort of the interest rate to reignite some of the inflationary pressures. They have to ensure that inflation is anchored before they go ahead. I mean, about 78% of the time, historically speaking, inflation comes in two waves. So, what the Fed basically has done now is that for 2024, it's not a no on rate hikes, it's a no for right now.
How much do you think of the disinflation we've seen that the Fed can really take credit for? This is something I've been wondering, and I feel like so much of it has just been like the supply side normalizing, from those big COVID disruptions and a lot of those supply chains getting back in order. Do you really think, though, Rob, that the Fed can take credit for a lot of what we've seen?
Yeah, I think we're in a territory, including the Fed, that no one has ever seen before. So, retail is working through that. Services are working through that. Federal Reserve, businesses are working through that. One thing's good is the supply chain got tighter and then it got sort of a lot more efficient, if you will. And I think a lot of businesses became a lot more efficient, even moving forward. So that's going to be leading to greater profitability for a lot of businesses that learned through COVID. But if you look at the shift in consumption, and 2/3 of the economy is consumption, it's basically the services sector that's still seeing that spike up. Look at airline prices. Look at all the inflationary prices where people are like shifting their spending. We just got retail sales, goods. American consumer will always find a way, whether it's the credit card or whether it's the savings that they had saved up to make certain that Christmas is still Christmas at home. But it's going to take some time to see. We're going to see a lot more pressure build on the consumer, but the shift in spending is quite clear. It's still services for this year.
Okay, we can definitely say there's something of a pivot, the degree to which you can argue about, and we're definitely headed toward that 2%, although with maybe fits and starts, so a disinflationary environment or outright deflation in some sectors. I ask this of all our equity guests. What does that mean for earnings, especially the top-line sales growth?
Earnings, if you look at, again, that's going to be at the forefront. We just had the two biggest points, year to date as it relates to the CPI information as well as job market. It's not exactly going in the right direction in terms of as much movement as the Fed needs to see, but the earnings is on the forefront. And corporations, if you look at tech 2 years ago, tech literally started laying off in anticipation of a recession. We're looking at banks right now. At the end of last year, they started laying off. So it's basically a rolling sector recession. Pick your company, but a lot of companies are basically being a lot more conservative. Now, that jobs number is basically not going in the direction that the Fed needs it as quickly as at least the markets would like it. So interest rates could come down quicker.
So a rolling sector recession, does that mean we're in an actual economic recession or heading toward one?
I don't know if that'll actually transpire. If you look at the last 2 years, different sectors have had recessions at different times. That's why I think this time is different from a quote unquote recession standpoint. I know we've been waiting for about a year and a half, holding our breath for the official data to come out. But if you look at the different sectors and the performance of the different sectors, outperformance in some and underperformance in others, I think sectors, that's where you have to sort of be tactical in your performance of your asset allocation as you look into the market for 2024. The sectors that perform the best on a relative basis, let's say technology, are still going to perform well this year, but relatively other sectors will sort of come back. Let's call it healthcare, energy. I think those are times to start looking at overweighting those sectors for 2024.
Okay, so I put all that into the blender, turn it on high. What do I come up with? Where am I going to put my money?
Again, the 60-40 sort of asset allocation is where we're at. We like about a 10% allocation within that 40 within alternative investments. But I really like energy for the first 6 months. I think obviously the geopolitical tensions that we're seeing, earnings growth in that sector alone is up 40% in the last 4 years. And then you also have buybacks. I mean, they're dividend rich right now. And so where they're going to basically have that free cash flow is how they're going to allocate that. And we believe there's a lot of value there, plus a lot of M&A activity that we saw is going to be accretive. So we like the energy sector moving forward. And then healthcare. Healthcare, again, just like energy, is going to present a lot of value. Plus dividends, you get paid while you wait.
So Robert, just in our last 30 seconds or so here, just have to confirm, you're coming to us from Palm Desert, California today, is that right?
Right.
Okay. Tell
wait,
me.
Is that a TV screen or your window in the background?
That's
Come on, be honest.
Screen. But if you look right through us, we've got basically a Palm Desert Chamber of Commerce, snow-capped mountains out here. It's 70 degrees, so come on out.
And also nearby is a beautiful tennis center, which I got to ask, are you going to be at Indian Wells in March?
We love the Indian Wells PNB tennis event. It's a first-class event. And it's international and it's growing every year. So it's a perfect time of year.
Yeah, that's big on my list for next year. This year, going to the Miami Open, though.
It always comes back to tennis for you.
It has to. We haven't even talked about the Australian Open yet. It's really just a huge oversight on our part. We will be getting that to you, everyone. Don't worry.
Bob, thanks a lot. Appreciate it. Robert Schein, Managing Director and Partner at Blanke Schein Wealth Management.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Goldman Sachs recently raised $650 million for investing in life sciences startups. Is this an area for you? Well, let's ask our next guest. Zoe Peden is a partner at Ananda Impact Ventures. She's joining us from all these guests in locations like I want to be.
Very tropical.
You go to Antarctica, then Mexico.
I'm telling you, the bachelorette parties are killer. But Zoe Peden joining us from Spain today.
Nice.
Buenas tardes, Zoe. What's up?
Doing well here, thank you. Very warm.
So let's ask you on the risk spectrum, where do startups in health, nature, and biotech, where do they lie?
Risk. So when at Ananda, we invest in very early stage impact ventures across all those areas. And it is, we are very early stage, so it is high risk. I mean, that's venture capital for you.
How much is...
But high reward if you get a home run on one of these. How many home runs do you get typically?
So in VC, you're looking in a portfolio of 25 to 30, maybe 2 max.
Oof.
But that's the name of the game. And everybody who works in this industry knows that. It's
a numbers game.
Yes.
That's right. Well, I mean, tell us about some of the home runs you've had and like to what extent you can tell us about them.
So some of the areas that we've been investing in terms of the life sciences that you were asking about, we've got a company called Closed Loop Medicine, and this one deals with dosage. So when you take a pill, everybody's taking the same dosage. It's an adult dosage and a child dosage, but we're not all made of the same things. Our biology is very unique to each of us, and as a result, many of us get side effects. And if you go back to how drugs were designed back in the 70s and 80s, there were not many women involved in those clinical trials. So many of the drugs that we take have much more exaggerated impact on female bodies too. So closed loop medicine works with pharmaceutical companies to do personalized digital dosage. So that's using artificial intelligence and tracking lots of data. So that's one of the ones. And then another one called Resistomap. It's a very recent investment that we've done, so very, very early. But with the recent pandemic, everybody's become much more aware of the need for biosecurity and how pathogens can be used as a weapon. And it's quite worrying, really. And one of the next pandemic that nobody really talks about is antibiotic resistance. So what Resistomap does is it's able to map all the different strains and say where all over the world where you've got the worst antibiotic resistance and make people aware of this.
Yeah, we especially with my kids, it's like every time they went to the doctors, they get amoxicillin or some antibiotic, and you had to start wondering about like the resistance levels and what the ultimate result of that is. Hey, as an average Joe, can I get in on the ground floor?
Can you get in the ground floor in impact investing or life sciences?
Well, any of the companies that you're talking about. This is like, I want to get rich too.
It's incredible. Yeah, I'm sure. Don't we all? But no, it's important, not just getting rich. It's about having impact as well and making things a better place, better healthcare for everybody, more accessible, and better lives for everyone. That's what impact investing is all about.
Got to think that there's got to be some kind of AI application here. So tell us a little bit how that's coming into your space and if that's something
the intersection of AI and life sciences, etc.
I don't know. It seems
that's
right.
That's what got my attention.
All right. Well, all right. Well, John wants to know about it. So tell John what's going on there.
Okay. So, I mean, we've just seen this money all going from Goldman Sachs. And I must say, it's not the only big fund that they've got. They've also got a climate fund as well. So Goldman Sachs are making some interesting moves just generally, not just in the life sciences. But we've seen lots of people go into the life sciences 20 years ago, similarly as they did with clean tech, and get quite bruised. So the question is, why are we seeing this again? That's where the AI comes in, making it cheaper, quicker to build models using existing data and synthetic data. And then your previous person that you had in the studio talking about compute power too. So in relevance to life sciences, you've got the ability to build new biological and chemical models as well, having this extra compute power. But what's also interesting, and I think this is where Goldman Sachs are picking up, is there's market forces as well. We're seeing this trickle down effect from the big tech players, those magnificent 7 that we're calling them now, investing heavily into this space. So you've got 6 out of those 7 from the magnificent 7 investing in healthcare and AI and life sciences. Just to give you one example, which I'm sure people are hearing about on the news. So Google DeepMind spin out Isomorphic Labs. So they're reducing the time for drug discovery signed 2 large deals worth nearly $3 billion with Eli Lilly and Novartis. So that's really interesting revenue, apparently coming in quite early on, which we didn't see with that first trend 20 years ago in the early 2000s. They were mostly developing single assets, single drugs. So if it doesn't work out, you spend an awful lot of money at the beginning stage to then lose a lot. So extremely high risk. So what we're seeing is we're reducing that risk by being able to discover more potential drugs using artificial intelligence, increase data to reduce the risk at every single stage of a life science business. And I think that's why you're seeing now Goldman Sachs and many other people forging back into life sciences, which is a very, very impactful area. So the more money that goes into this and the more chances we have for success, this is a very good thing for everyone.
Zoe, do these companies come to you, or do you go scout these companies out? How does that work?
Oh, it's always a bit of both, actually. What we like to do at Ananda is we have certain mega trends that we go for. So we've got certain fields in different areas of impact that we feel are the hot areas over the next 5 to 10 years. And for instance, we've started to focus a lot of time now into tech bio companies. So this does come under life sciences, and it's one particular area which is more about computational biology. So using AI with biology. So it's the less capital intensive end of the life sciences, just let's say that. And that's where we're expanding our field. And we will often go out and look to the universities, work with the angel investors who have a background in this area, and go out and find as much as we do, they come to us. So it's pretty much a half and half sourcing strategy.
So Zoe, you started out by telling us that, for every 25 or so strikes, maybe 2 or 3 of them hit. So it's obviously a lot of them that don't work out. I know we don't like to harp on our, misfortunes, but can you tell us about maybe some of these that haven't worked out for you guys?
Difficult to name names right now, but what will tend to happen is it's kind of, if they've gone for a single asset strategy, if you're talking about life sciences, you spend a lot of money up front. And if that one doesn't turn out to have the product market fit, so people are not willing to pay at that point, but you've had to spend a lot of money and you run out of money. It's as simple as that with the life sciences. So that's why many of them haven't worked out in the past. But like I was saying, with everything that's happening now, you get more bites at the cherry with artificial intelligence in these companies. So it's reducing that risk and being able to spot what's not going to make it. Just saying, time is the most precious thing for these entrepreneurs as well as investors. If it's not going to work out, let them go again. Let them build on the failures of that one, because all science is built on on the shoulders of many of those that have gone before. Let them roll again into another one. So failure is not the disaster as many see it would be painted. It's just the next stage.
Zoe, a pleasure to talk to you. Appreciate you stopping by.
Thank
Zoe
you.
Peden, partner at Ananda Impact Ventures, joining us from, I'm so jealous, Spain.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
Can I say jaw-dropping data this morning on retail sales?
Yeah, why not?
I mean, it was just like way off expectations.
The consumer, loves to surprise. That's no recession? That's been the story, John.
Or I think, as I put it, the consumer is not falling off a cliff.
Yeah, that was your crystal ball this morning. You nailed it. And I said we had to hold tight just to make sure.
A U.S. retail sales, as Molly wrote in the Bloomberg story that you can read on Top Go, rising at the strongest pace in 3 months in December. Treasury yields popped on the news. So how does this all gel with the current investment climate? Let's put that to our next guest. Geetu Sharma, founder and investment manager at AlphasFuture, joining us from, I'm going to guess, the coldest place on the planet Earth right now, Minneapolis. How bad is it?
Hi there. Yeah, it's pretty cold here. I think with the wind chills, it's about -20.
Oh,
Worse than Antarctica.
Molly's just back from Antarctica. She says it's colder here in New York than it was in Antarctica.
I'm serious. Antarctica, it's summer right now. It's beautiful down there.
All right. Well, anyway, every time I count out the American consumer, I'm dead wrong. What do you make of the data that we got today? And more importantly, what does it imply for Fed policy and just markets overall?
Yeah, I think like you were talking earlier, the consumer remains very strong and is consuming, is willing to spend, and we're not seeing any kind of slowdown in demand right now. Besides the strong retail sales data, we also read about positive home builder sentiment, the mortgage demand going up as well. And last week we saw unemployment rate at about 3.7%, which is one of the lowest for 50, 60 years. So we're really not seeing any kind of sharp, significant slowdown that would imply that a recession is coming. In fact, we're seeing a consumer and an economy that continues to be very strong, very resilient in the face of high interest rates. And inflation has come down. So that, of course, is giving a positive boost to the consumer as well.
Of course. And, you had mentioned in your notes just before the show, Geetu, that the outlook for disinflation remains uncertain. And obviously we did see that CPI report. I believe that was last week. The time is flying, but it was, as you said, it's a bit bumpy. So how are you parsing through these different reports and really, sticking to your guns that inflation is on a firm downward trajectory?
I think it's at this point of time, it's really hard to say how far inflation will go down further. We've seen some really sharp declines in 2023, and that has brought inflation down from 9%, from a high of 9% in June 22 to about 2 to 3% right now. But it's often said that the last leg is the most difficult, and we did see the recent CPI data slightly nudge up. And one of the biggest challenges, I think, for the Fed is that wages continue to be very sticky, and that's trending around 4% right now. And that can keep inflation at the current levels of 2 to 3%, which is still above Fed's target. And as long as the economy is staying strong and the inflation is stable at this higher number, I don't see how the Fed would want to cut so rapidly as the market is expecting.
S&P 500, as you mentioned, it ain't cheap at this point. But I look a little broader, small, mid caps. Not only do they seem to be massively under-owned by investors at this point and by institutions, they're about 13 to 14 times earnings. You can own these. Is that an alternative?
I think it's a very difficult situation in terms of investing right now, because what we've seen is a large part of last year's rally was driven by tech and AI and secular trends around AI. And the rally was not only in the large cap tech, but also in the small and mid cap tech. So there is this segment of the market which has high growth, strong cash flows, profitable, and continues to do well and has expensive valuations. On the other hand, you have everything else in the economy, whether it's industrials or discretionary or even the defensive sectors that have not participated in the rally, have underperformed last year, and are at, especially the industrials and the financials, energy sectors, they remain exposed to recession risk. So they're more cyclical and have downside risk if we do head into a recession. So the question is, do you continue to invest in tech, which has this positive profitability, demand, growth trends, but is expensive? Or do you, how much of your portfolio do you weigh in towards some of these value sectors which have not performed so far?
Is there like a magnificent seven in like small and mid caps?
I don't think so.
All right.
They're all magnificent across the board there. Geetu, so if we're talking about the possibility of recession, I feel like we've got to talk about these Fed wagers here and looking at investors that are pricing in as many as 6 rate cuts next year. Obviously, the Fed's dot plot indicating just 3. Where do you stand in that debate? Because that's a pretty big discrepancy between 3 and 6. And also, why do investors just not believe the Fed time and time again?
So I think the market tends to swing from one end to the other. And a lot of the market projections as well as the Fed projections have not come through for a while. The market expected recession in 23. That didn't come through. We were expecting one more rate hike towards the end of the year. That didn't come through. So there's been, data has been shifting. And it's really, hard to predict what's going to happen. But clearly, this difference between what the Fed is anticipating, which is a soft landing scenario, stable growth, inflation going to 2% by 2025. The Fed is looking at normalizing interest rates to about 4.5% this year. Whereas the market is forecasting a more dire situation that ultimately leads to a recession, and the Fed has to cut a lot more.
Okay.
I think this remains a big debate in the market right now, and every day we are seeing moves that are reflecting a shift from one side of this debate to the other, not really finding a direction.
We're going to have to leave it there. Geetu Sharma, founder, investment manager at AlphasFuture. Thanks for being with us today. I really appreciate it. From, what'd you say, 20 below wind chill? Minneapolis?
Will not be signing me up for that.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Investors questioning the timing of Fed rate cuts, among other things. And with that context, let's bring in our next guest, Molly. Ron Sanchez, the Chief Investment Officer at Fiduciary Trust International. Hi, thanks for stopping by.
Great, thank you. Thanks for having me.
So what's in the driver's seat?
Well, from a market standpoint, I think markets are sort of languishing a little bit here because there isn't a catalyst. We had, as you well know, markets ended the year on a strong note. We already have seen the two important economic data for January. That was the labor report and CPI. So at this point, I think the focus turns to earnings. We've seen a couple of bank earnings, but we will see earnings over the next 2 to 3 weeks that'll give us an idea about how the macro is filtering into the micro, and perhaps more importantly, CEOs' expectations for 24.
Give us a little sum of what we saw from the bank earnings and what your biggest takeaway was from that.
Yeah, so almost status quo. As we expected, nothing alarming, and economic activity and the banking system remain in good shape. And I'm not sure that sort of bank earnings signal much on the macro. We have to wait for other companies.
Well, for sure, maybe the last mile is going to be real difficult to get to the Fed's target of 2%, but we are in a disinflationary, or in some sectors outright deflationary environment. What does that do to earnings?
Well, it creates two things. I think it's going to be much more challenging to pass on. And so revenue and profit margins are going to be needed to sort of
pricing
be
power
maintained.
Evaporates for
it
some?
Does indeed. It does indeed. I think there's, after 2 years of where not only did you pass on rising input cost, but a little more. And I think that environment is clearly behind us. I think it's much more challenging. And if you do raise prices, you could see it manifest itself in lower volume. So there's that trade-off between sales volume and sales revenue.
But prices are still going up, no? I mean, yes, at a slower rate, but I mean, there still is some pricing power there, maybe just not as much.
There is, and I think as we move on, it'll be less and less. And so at least as we sit here today, the moderation I think is evident, and especially sort of in the goods market, it definitely is.
Okay, so what do you like at this point?
So I think the market looks, broadly speaking, looks compelling to us. I do think the first half of the year is going to be choppy for risk assets, i.e. Equities. I think we pulled forward a fair amount of return into the fourth quarter. The soft landing that became evident by year end, again, 23 was about the hard landing, the no landing, but ultimately we've landed on the soft landing. And I think that's the high consensus or conviction trade. And so the first half of the year, I think for risk assets, is about a choppy market as you look to validate that, meaning I need to see economic data decelerate, not too much, come into around a trend or slightly inside of 2%, and I need to continue to see labor markets soften, and the same for inflation. In that environment, I think it sets up better for the second half, and that's one of the reasons why fixed income is attractive for us, because I get paid to wait.
Probably more attractive on a day like today as well, when
That's right.
you see what was the 2 years up? Did you say 13 bips before it, John?
Yeah, 435 the yield right now, 13 basis points higher. The 10 up 6, 412. We both, Molly and I both missed 5%, but
Speak for
just
yourself.
Oh, okay. Sorry. That's why she's going to Antarctica and Mexico. But we missed the boat. I missed the boat on 5. 412 still a screaming buy?
I don't know about a screening buy, but it's attractive on two fronts. One a carry trade, and so looking at sort of risk-free return of 4.25 is appealing, and it gives you a hedge in case the economy does decelerate faster than we think. It'll be a hedge against risk assets that'll come under some pressure, and I think you could see if we do have an economic recession, again, that's not our view, interest rates will come down inside of 4, and you'll have a total rate of return that, again, is reasonably
Asset
attractive.
allocation, you're what, 60-40?
That's right, and so we are neutral on U.S. equity, slight underweight in Europe, and a slight overweight in fixed income.
So you're saying we're looking for a catalyst right now, earnings being one of them. But I guess on the eco calendar, we do have a Fed meeting in 2 weeks. I guess maybe not expecting to be particularly exciting from a policy standpoint, but any early thoughts ahead of that, and what new clues we might be hearing from the Fed, and just maybe the timing of cuts this year?
Sure. I don't think we're going to sort of hear much. They are coalescing around the hold. I don't think they want to pre-sell a cut, and I think they want to have some patience here. I know the market thinks differently. It's building in a first cut in March, and for us, it's just too premature. March is not a line in the sand. I think the way investors need to be looking at this is that I am going to see the Federal Reserve move from a fighting inflation campaign in 23 to managing the economic cycle in 24. And if the economy moderates as we expect, there'll be latitude and scope to lower rates. 5.5 is not the right number. So I think it's more of a second half development. And again, under the heading of watch what you wish for, if they were to move in March, given the fact there's only 2 more labor reports, you would need to see more of a rollover of economic data for them to move, and I prefer to see the economy moderate than roll over. And
I think we all would prefer that.
Yes.
Let's throw politics into the mix. I'm hearing the word tariff pop up again and again by a certain candidate. What sort of risk does that bring into the equity space?
Well, it just adds to a fair amount of uncertainty from a geopolitical and here in the U.S. as well. Obviously, we're early. It's an election year. I think in the first half of the year, though, it will be more about the economy and about the Fed and inflation. In the second half of the year, I think you could see market volatility attributed to political developments.
And the conventional wisdom is that Fed policymakers aren't going to act close to an election. Do you believe that? And how does that sort of change the timing of the expectation of rate cuts?
Yeah, I do not believe that. I think they're in an environment where they have been very aggressive, needed to be to fight inflation. I think their job is complete on that front, and they are in a restrictive posture. And as we move closer to election, there's a lot of economic data to see where we end up and whether it truly is a soft landing and where inflation ends up. And I think in that regard, the Fed would like to moderate its stance and move from restrictive to neutral.
I think they're also, pretty decisively in, a pivot right now toward lower interest rates. So I don't think that it would really be as controversial if they were to, cut interest rates sometime around the election, if that's obviously so pre-calibrated at this point.
I'd agree with that.
All right,
they can't afford to pass.
Time to put you on the spot with my unfair questions, but how many cuts this year from the Fed, did you say?
The Fed thinks 3, the market thinks 6, and I think it's between 3 and 6. It's at least 3.
That's a safe
and
guess.
I'd say 4 or 5.
So S&P 500 year-end target.
I would say, so a modest return of 5 to 7% for the S&P 500.
All right, so 5,000
5,000,
somewhere?
that's right.
Okay, all right.
That sounds like a good number.
I'll settle for that.
Around.
Yeah.
5%.
Okay.
Thanks. Good to see you. Ron Sanchez, the Chief Investment Officer at Fiduciary Trust International, coming in from the islands, Long Island.
Yes, to the island of Manhattan.
Thanks for listening to the Bloomberg Markets Podcast. You can subscribe and listen to interviews at Apple Podcasts or whatever podcast platform you prefer. I'm Matt Miller. I'm on Twitter at MattMiller1973.
And I'm Paul Sweeney. I'm on Twitter at PT Sweeney. Before the podcast, you can always catch us worldwide at Bloomberg Radio.